Hello and welcome to Swag Academy. In this video, I will make an in-depth stock fundamental analysis of the company McDonald's. I will cover its history, business model, growth and revenue, profitability, balance sheet, valuation, and finally do the 3M analysis. So make sure to watch till the end of the video. McDonald's was founded in 1940, 84 years ago. Its headquarters is in Chicago, the United States. The company has 150,000 employees. It has a $183 billion market cap. Its stock is trading around $254 at the time I'm making this video. McDonald's makes money by leveraging its product, fast food, to franchisees who have to lease properties that are owned by McDonald's. The advantage of this model is that the revenue stream, rent and royalty income received from franchisees is far more stable and predictable. The operating costs, on the other hand, are measurably low, which allows for an easier path to profitability. McDonald's can leverage its market position to negotiate deals because it has control over the land and long-term lease. This is like a subscription where the subscriber pays a fixed amount each month. The company franchises restaurants that serves beverages and fast food across 100 countries. It has reached over 41,000 restaurants globally in over 100 countries, which serve more than 65 million people every day, or more than 1% of the total population of the world. McDonald's is facing fierce competition from other fast food suppliers. However, it is the largest fast food chain worldwide and is still growing its revenue. McDonald's revenue have been declining since 2014. It reached a low in 2020, then started increasing to higher levels. This is surprising since McDonald's is constantly opening new stores and should make more revenues. However, to be fair, the new revenue data does not include the sales done in Russia. All the restaurants have been closed in Russia. This chart shows the number of new openings every year. As you can see, over 1,000 new restaurants are opening every year. The majority of McDonald's revenue and income comes from the restaurants in the US. It is by far the biggest market from a country perspective. Now let's check the profitability of the company. The gross profit is a result of revenue minus the direct cost to create these revenues. The gross profit margin is a result of gross profit divided by the revenue. The gross profit margin shows the amount of profit made before deducting selling, general and administrative costs, which is the firm net profit margin. The gray line in the chart represents the gross profit margin over the years. McDonald's gross profit margin is 57.1% in 2023. It is clear that the company gross profit margin is increasing over the years, which means the company is getting more profitable and efficient every year, something I really like to see as an investor. Next, let's check the operating profit and the operating profit margin. Operating profit is a net income derived from a company's core operations. It is the amount of money that the company has left over after meeting its operating costs but before paying its taxes. McDonald's is a very profitable company. It made $11.7 billion operating profit in 2023. Here again the trend is clear. The operating margin, which is the blue line in the chart, is increasing, just like the gross profit margin, which means that the company is getting more efficient and profitable every year. Very good development. Now let's have a quick look at the free cash flow. McDonald's made $9.7 billion on free cash flow in 2023. A very good value. Considering $25.5 billion on revenue for 2023, the free cash flow yield is 38%. Amazing result, especially when you compare the numbers to competitors. The company is very profitable. Next, let's check the efficiency of the company. In other words, analyze the operating cost. The operating costs for McDonald's have not changed much the last 10 years. They are around $2.8 billion. They increased since 2018 to reach the current level. The small increase is probably due to inflation. Especially the last 3 years, inflation have been very high worldwide. Now let's have a quick look at McDonald's balance sheet. McDonald's have $7.98 billion in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investment. The total current liabilities are the liabilities which the company must pay within 1 year. McDonald's total current liabilities are $6.85 billion. McDonald's long-term debt is $37.1 billion. By calculating the current assets minus the current liabilities years, McDonald is left with $1.13 billion cash on its balance sheet. McDonald can use this money to buy back stocks, invest in the company, or to buy another company. So there will be no financial issues for the next year. However, the long-term debt is very high, considering McDonald has $9.7 billion free cash flow. It will take the company 3.8 years to pay back the debt. Furthermore, the revenues are not growing, which means McDonald's issued debt to finance the operation, not the growth, which is something I don't like to see. Although McDonald's is opening new stores, the numbers are not showing as a revenue increase. Now let's jump to valuations. McDonald's have a 7.2 price to sales ratio, a 21.59 PE ratio, an 18.91 price to cash flow ratio, and a 2.31 PEG ratio. Pause the video and check how the current ratios compare to previous years. For a company without revenue growth, the valuation are high. To be fair, however, the earnings have grown by 4% annual compound rate every year the last 10 years. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downside, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering a 4% growth for the first 5 years, a 4% the 5 years afterwards, a terminal multiple of 8 and 15% discount rate. The intrinsic value of the stock is $120.28. McDonald's is trading at $254, more than double its intrinsic value. Finally, the 3M analysis, 1M for moat, 1M for management, and 1M for margin of safety. McDonald's have a good moat. Firstly, it has a strong brand that is known and famous worldwide. Secondly, the stores operate in strategic location with high density of people or visitors. And McDonald's owns these stores. Management are doing a good job increasing the earnings of the company. They are investing in the business, paying dividend and repurchasing shares. As you can see in this chart, the number of shares is decreasing every year. Nevertheless, I believe this is not the best decision for management. I personally don't like companies who have a lot of debt to pay dividend and take on more debt to grow and finance the operation. Furthermore, based on the discounted cash flow analysis, the stock price of McDonald's is very expensive. So doing shares buybacks at expensive prices does not make a lot of sense. I would prefer if they invest in growth or improving their efficiency and cost structure. For the margin of safety, McDonald's is very expensive and is trading at double its intrinsic value. McDonald's is owned by some value investors. Pause the video and check who they are. However, it is not a main position in their portfolio. The highest portion McDonald's position taken in a portfolio is 0.93%, less than 1%. Now let's see what analysts think of the company. For analysts, the average price of McDonald's should be $313.62, which is higher than the current price. Furthermore, they consider the stock as a buy, strong buy and hold. Now let's have a quick look at insiders buying and selling. As you can see here, some are buying, others are selling. It is normal, nothing exceptional or remarkable. In conclusion, McDonald's is a good company. They have a very well-known brand worldwide and a good moat. They are profitable and increasing their profits every year. The company is a cash flow machine. Its cash flow yield is 38%. However, they have a good amount of debt on their balance sheet and the revenues are not growing as they should. I prefer to invest in great companies at a fair or cheap price. McDonald's is only good and expensive, so I will not invest in the stock. Let me know in the comment section below what you think of the company and if you will buy the stock. If you have found value in this video, please give us a like, this helps a lot, and consider subscribing. Thank you very much for watching.